Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, we're very pleased you joined us for our next presentation from Paladin Energy. Please note you can submit questions for the presenter in the box to the left of the slides. And at this point, I'm very pleased to welcome Alex Rybak. He's the Chief Commercial Officer of Paladin Energy, which trades on the OTCQX Best Market under the symbol PALAF and on the ASX under the symbol PDN. Welcome, Alex.
Thanks, John. Appreciate the invite to speak at your conference. As you know, we're really excited to be bringing Langer Heinrich back to production in a very strong uranium market environment. If you recall, we made the decision to restart Langer Heinrich with only one contract. Uranium prices were just starting to pick up. And today we've got a well-functioning uranium market that's trading on fundamentals, uranium price at very healthy levels and where it should be. Our project is close to 90% complete and on time, on budget. So the moons are really aligning for us to bring Langer Heinrich back to production. And today I'll give you an update on the restart project. I'll share some insight in what we're seeing in the uranium market as we continue to contract, and we'll talk about what's next for Paladin after we restart Langer Heinrich. So let's get into it. Paladin is one of the few non-state-owned publicly listed companies with global scale uranium operations. We capped at about 3 billion Aussie and part of the ASX 200 index. We have assets in premier uranium mining jurisdictions, being Namibia, Canada, and Australia, and I'll talk about each of those. Unlike with many other future-facing commodities that investors are looking at today, demand for uranium is here and now. Demand is underpinned by existing and extensive global nuclear reactor fleet of about 440 operable reactors and about 60 reactors under construction. Reactors have annuity-like stream of uranium requirements that go out for decades into the future. And support for nuclear has been, as you know, driven by global decarbonization and energy security requirements, and is truly global, and we're seeing that support right across the world. In US, there is bipartisan support for nuclear, with the Inflation Reduction Act, for example, providing significant tax credits on par with putting nuclear on par with wind and solar. In EU, nuclear has been included as part of green taxonomy. And in China, there's a massive reactor build-out program, which is underway with 150 new reactors planned over the next 15 years. I've been to China just recently, presented at their nuclear fuel conference, met with all the utilities, and it's really interesting that they're actually delivering on that program, and they're actually connecting 9 to 10 reactors per year to the grid. This is really why many industry commentators talk about this nuclear renaissance. The industry has got very strong fundamentals, and the uranium price environment starting to reflect that. I'd like to talk a little bit about structural supply shortage. It's well documented, but what I would say is in uranium, it is here and now. It is not something that we expect to happen in the future. It is here today. And it is because of the underinvestment in uranium over the last decade, and on the supply side and on the demand side, we've got additional demand that is coming through from reversal of nuclear phase-out programs around the world and reactor life extensions, many of which are happening in the US. Current deficit in the market is in the order of 50-60 million pounds per annum, and we expect that deficit to sustain at about 35 million pounds per annum over the next decade. New mines, as you know, new uranium mines take many years to come to market. It's a highly regulated field. And that's why the beneficiaries of the current cycle will be existing producers and restarts like Paladin. What's been keeping the uranium pricing back a little historically has been the level of inventories in the system globally. The industry consensus now is that the inventory overhang is over, and that's why we're seeing this strong uranium price performance, with uranium prices now over or around $80 mark. Historically, over the last decade, utilities relied on secondary supplies and carry trades and the drawdown of their inventories. You can see on the chart, light green area, those inventory drawdowns are shrinking significantly, as well as secondary supplies from countries like Russia are also shrinking, and there's a switch from underfeeding to overfeeding that's also underway. As a result, utilities are returning to long-term contracting with primary producers. And this is a really important piece of data. This chart on the right-hand side shows the level of term contracting that UXC tracks from year to year. You can see that term contracting volumes have really picked up significantly from last year, and this year already returning to replacement level term contracting of about 150 million pounds. Utilities purchase over 80% of their reactor requirements in the term market. And we're seeing the demand right across the globe. But what's interesting is that you see the composition change in the last year or two, with a lot of demand coming from non-US utilities. That's manifested itself through Chinese utilities locking up pounds with signing contracts with Kazatomprom and Cameco, and with Cameco signing contracts with Eastern European utilities, and have putting those pounds into the non-traditional markets away from Western utilities in US and Western Europe, which is now causing those utilities to come to the market and really try to seek supply and seek material on a more urgent basis. As a result, we're seeing this healthy price escalation that is driven by utilities. It's also driven by producers who are short material. All of major producers like Cameco, Kazatomprom, the Russian producers are short material and are buying material to meet their contract obligations. This is primary demand, primary supply, and it is good to see that that's now in the market and supporting uranium prices. What we're seeing is what we have been seeing is a orderly market where utilities have been able to procure all the uranium requirements they needed in an orderly fashion, with steady increases in prices. However, we're starting to see first signs of some developments that are quite interesting to note. For example, recently a non-US utility put out an RFP and got 0 responses. It was deemed by producers that the terms of the RFP weren't favorable, and no producers put in responses to this major utility for quite significant volumes of about 6 million pounds. That tells you that it is now really a seller's market. Sellers are no longer willing to take terms that are sub-economic, that are not attractive. Sellers are now dictating their terms, as we are seeing that, and that's a very welcome development in the market today. Paladin is a preferred counterparty for a number of reasons. Not all boats rise in a rising tide is what we're seeing. We're seeing a lot of utilities come to Paladin because Paladin is able to deliver diversification to some of these utilities. For example, according to recent Euratom report, 70% of European requirements come from 3 countries: Russia, Kazakhstan, and Niger. And with all the unrest in those countries, you can see why utilities are really keen to get some Namibian origin supply, which we can provide. They know that Langer Heinrich is a proven project. They've received material from Langer Heinrich in the past. Langer Heinrich never missed a shipment, and we can provide long-term supply agreements with Langer Heinrich's long 17-year mine life. This cycle is really for the incumbents, like Paladin, who will have or who have production or who will have production in the near term, and Paladin will benefit from this cycle. We took the decision early on to put in place a high quality contract book focusing on very high quality counterparties in US, Europe, and in Asia. We now have 6 offtakes totaling about 18 million pounds to 2030. More so if we count beyond that period. We're about 50% contracted to 2030. And about 20% of our production is at what we call price protected levels, base escalated and fixed prices. But what's interesting is over 80% of our production is still exposed to spot prices. Our offtake with CNNC is uncapped, which is extremely rare in today's environment. And we're really well positioned for the upside in the uranium market, but we also have some downside protection. Now I'd like to just give you a recap on Namibia and provide an update on the Langer Heinrich mine and the restart project. We have 75% ownership in Langer Heinrich mine. It operated successfully for 10 years and produced over 43 million pounds of uranium. What's interesting, it was cash flow positive at the mine gate when the decision to put it on care and maintenance was taken. But the decision was taken to protect the metal in the ground, and it was the right decision due to the protracted down cycle, and now we are able to reap the benefits of that and contract that uranium and that production at very healthy price levels. And Langer Heinrich is located 125 kilometers inland from the deep water port of Walvis Bay in Namibia. Namibia and that region has great infrastructure, roads, power and water. We have strong government support. I was in Namibia recently, met with the mining minister and the MME. We're receiving strong government support across all government levels. We have all the permits and licenses in place. All of our offtakes have been approved by MME in a timely basis. It's a really good place to operate. And we have what's really important for us. We have access to highly skilled workforce because it is a uranium mining producing jurisdiction. 2 other world scale mines currently in operation, being Rossing and Husab. Many of the guys that worked at Langer Heinrich previously are returning to Langer Heinrich. We've been very successful with keeping our project on time, on budget, targeting for first production late in Q1 next year. Our project is close to 90% complete, physical completion at this point in time. We are progressing into plant commissioning phase. And the first ore is going to go into the crushers in January. This is really exciting time for us. We're expecting to produce first drums of yellowcake in March. So this is really not far away. We're a bit of an outlier in the industry with our project at this point in time being on track, on time. We're really excited to recommence operations and bring Namibian uranium into the world arena. We've had close to or over actually 1,200 people working on the restart project, and we're now starting to demobilize that workforce. We only need about 300 people working in normal level state equilibrium sort of operations. As I said, we haven't had problems recruiting the workforce. We've got pick of the bunch in terms of the people that we employ, and the level of skilled labor is fantastic. in Namibia. We expect to, as I mentioned, we expect to feed first ore into the crushers in January, and we'll be doing that for the first 12 to 15 months, feeding ore into the plant from the existing stockpiles that we already have. We will then recommence the mining phase of the project subsequently. But in the first ramp up phase, we'll be using the existing stockpiles, and we've already appointed a mining contractor, Trollop, who for the stockpile reclaim phase. As you can see here, this gives a good snapshot of the project and the 17-year mine life. After the first ramp-up period of about 15 months, we'll be moving into the mining phase, and the project will operate at about 6 million pounds per annum production level. We will then move back into the stockpile phase with annual production of about 3.5 million pounds per annum. And what I would say is this is very much a base case. We think quite a conservative base case, and there's plenty of upside within Langer Heinrich to optimize existing infrastructure and bring on additional resource through that existing infrastructure. As you can see, this is a globally significant mine, which will be producing around 4% of the world's uranium supply. Now I'd like to talk about our wider portfolio of projects. Across our 3 jurisdictions, Paladin has one of the largest uranium resources globally, with over 400 million pounds of uranium on net interest basis. In addition to Langer Heinrich, we have an exciting project in Canada, Michelin, on the east coast of Canada, and we have 2 advanced exploration projects in Mount Isa in Queensland, with almost 150 million pounds of resource, and Mount Isa being a premier mining jurisdiction in Australia. And we have Meninjing Calibre in Western Australia with over 40 million pounds of resource, and those deposits are ISR amenable. Currently, there are moratorium on uranium mining at state level in Queensland and WA, and we'll take our Australian project forward once policy is more favourable. So now we're really focusing on Michelin as the next cab off the rank after Langer Heinrich, and we're really excited about Michelin. We've recently increased our ownership in Michelin to 100%. We also have an exemption at Michelin to operate without a Canadian partner, owning 100% of that project. We've completed extensive exploration work over the last 12 months, and we're about to start drilling at Michelin for the first time in the last decade, which is really exciting. Historic scoping studies presume the combination of open pit and underground mines and envisage an operation of about 6 million pounds per annum. So again, very significant operation potential there. And we are now looking and we'll be targeting more shallow lying material and focusing on the open pit potential of those deposits, which is really exciting given what's also happening in the uranium pricing, which is making this project look even better. We look forward to updating the scoping studies and making a decision on the development pathway for Michelin next year. As you can see, we've been incredibly successful over the last 2 to 3 years, and there will be much more success once we're operating and generating cash flow. There are only a handful of uranium companies that are independent, non-state owned, and publicly listed, and those that have projects that can benefit within the time frame of the current cycle, and Paladin's really at the top of that list. So you can see that's why we're really excited about this alignment of both the project and the environment, and we look forward to bringing Langer Heinrich back to production and progressing our other projects in our portfolio. And if you have any questions, please feel free to reach out to our investor relations team. The contact details there on